An important voice joining us on the very same to give us a quick view on how the oil market particularly is likely to play out in the very near term. And remember, it's a very emotional market, a market that has been all over the place over the last 6 months. But this fall of about almost 20% plus from the recent highs of 85 and beyond on Brent crude has taken the world by surprise. Is it just a reversion to the mean, or is there more in store? And is speculation at play when it comes to the oil market? We are joined by Jeff Brown, President, FGE Group, to talk more. Jeff, great to have you on the show. Thanks very much for taking out the time. Crude prices have fallen about 17% in the last month. What, in your mind, are the factors responsible here?
It's been a steep ride. I mean, there's really two things that have happened. One is the U.S. has put sanctions on Iran. The market was surprised that they gave waivers to 8 countries. And I think that contributed to the last part of the price fall. The other thing out there really is that the U.S. has been surprising very much to the upside. The U.S. production increased about 900,000 barrels a day. So essentially we added in the U.S. more than a total India production in only 3 months. So over the summer, the U.S. just went up incredibly. And the combination of these two things has really put pressure on the market as inventories have built.
Right. You know, the Saudi oil minister yesterday commented that they would be adjusting oil output lower by about 1 million barrels per day to start with to support oil prices. What did you make of that? Would there be sufficient supply to adjust for the prices?
Yeah, I mean, they're looking at similar numbers to we are, where we see OPEC really needing to cut back about 1 million barrels a day to make the market balance over the next several months. They're getting to start with that with 500,000 barrels a day. But actually, we think that they will need to do some more. We do expect that they will do some more. It won't necessarily be announced in a big way, but in the background, we think they will trim supplies to try to help support price. And again, the market's starting to price that in the sense that we saw this bit of a bounce back.
Jeff, hi there. Now, the Saudi minister also said that $86 on Brent was an extreme price on the higher side, but 70 is also extreme on the lower side, and he also expects that, we will see prices hover around $75 in the medium term. What about you? What are your price expectations? What's the kind of range that you're expecting?
Yeah, realistically, they like 70 to 80, right? Because if you go above 80, the U.S. gets upset, and especially President Trump. If you drop below 70, it hurts their budget. For them, that's a natural range. We think they're going to struggle to keep it around 70 in the very near term, especially when the first part of 2019 we could see it a little weaker. But it all boils down to, at the end of the day, the sanctions and how much the U.S. wants to push Iran. Because if they push Iran lower, the market will tighten up again, especially in the second half of 2019. But we need to get ready for prices bouncing around right around this 70 range. We think this is where we'll be at over the next several months.
And how are Venezuela and Libyan supplies coming back on track? What's the key reason for the spike in prices recently?
Yeah, we've seen a lot of bounces in terms of supply. I mean, Venezuela has been bouncing around, but Libya has really come back. They're up near the highest they've been in many, many years. So that has put pressure on price. Russia's producing a whole lot more. U.S. is producing more. Saudis are producing more. So when you put all this together, that's why we've seen this big, this drop in price. So now it's up to the Saudis and OPEC to clean it up, really. If they want to keep prices where their target is, they're going to have to clean this up.
Right. How do you see Russia's stance right now and the commentary coming in on crude oil prices?
Yeah, Russia's in a tough situation in the sense that they want to cooperate with the Saudis. Clearly, the oil minister has said that they will cooperate. The Russian oil companies are not as enthused as you might expect. They want to keep maximizing production. Russia has really come up. They've come up about 300,000 barrels a day. They're up 500,000 barrels a day year on year. certainly they can be a help, but internally they face a lot of pressures. We believe that they will trim back, but it won't be to the same level that they did last time to try to help the OPEC members out.
Right. Quick question then. How do you see the winter demand coming in for U.S. For oil prices now that they have become net exporters themselves?
It was mixed in the early part of the winter, but now most of the forecasts are that the big consuming areas of U.S., Europe, and also North Asia, we're looking at warm winters so far, and that's all the forecasts. If that comes true, we cut out about 500,000 barrels a day of oil demand, roughly, and that makes OPEC's job even harder. So they aren't getting any help from the weather currently, or at least the weather outlooks, I should say.
And structurally, what are the factors that you're observing which will impact the crude oil market and hence prices in the medium term, say for a 1 to 2 year period?
There's a few key things going on. And one is we have to think about demand. Demand growth has been very solid. It's still solid even though there's worries about the economy growing forward. We expect demand to stay about 1.5 million barrels a day. So as long as that happens, then we have to turn to the supply side. And there's a lot of moving parts. I mentioned Iran sanctions already. We expect Iran to drop another 500,000 barrels a day or so under U.S. pressure. The U.S. will continue to increase about 1 million barrels a day plus, and then it falls into OPEC's hands. But overall, we look at oil prices bouncing between in a 65 to 75 range. But it's a lot of politics in the background. You think about it. It depends on President Trump. It depends on Russian politics. It depends on OPEC politics and all the countries in OPEC. So in terms of the oil price over the next couple of years, it's about as politically driven as it always has been, as it ever has been. It's always politically driven, but it's going to be extreme over the next couple of years.
Right. In that light, give us your own sense on how are global hedge funds positioned in the oil trade right now?
Well, they had been very long, but then they pulled back a lot in line with the fall in crude oil prices. We're going to have to, they tend to bounce around with the oil price and sentiment. They tend to be, in some ways, a reflection of sentiment, which correlates quite well with the oil price, but it's not always the main driver. They're looking at those same factors that we're looking at right now, and they're making their calls in terms of how they want to position, of course.
Jeff, let you go on that note. Appreciate you taking the time out and joining in with a perspective on crude oil prices, where it's headed, and all that's going on in the world of commodities.